Good afternoon, and once again, thank you for joining the Cavalier and Tradition webinar series. My name is Jonathan Zeminski, and today we're going to be talking about creating a financial plan for the future. So as we get started, let me give you a quick background on who I am and really why you should be listening to anything I have to say today. So I am currently a Vice President and Senior Financial Advisor with Univest Bank and Trust as part of their private client group. I'm also a certified financial planner. I had the pleasure of graduating from Cabrini College in 2004 with a bachelor's degree in finance. I also have a master's degree in financial services from St. Joseph's University. And I'm very, very proud to say that I'm finishing up my first semester teaching here at Cabrini. So let's get started. And I always like to start with quotes. And the first is by Iron Mike Tyson, who it's taken kind of out of context from financial planning, but it's really sage life advice and something, from a source I would consider somewhat unlikely. And the quote is, "Everybody has a plan until they get punched in the face." And I really love this quote because no matter whether the blow is a health issue, a job loss, or a bad investment, it's how you react to adversity that defines you and not necessarily the adversity itself. And when it comes to financial planning, there's no foolproof plan, but rather a lifelong process that will have bumps and bruises along the way. Which leads to our second quote, which is, "Wealth is rarely created by a singular event, but rather through a series of best practices executed efficiently over time." And I also love this quote because it reminds us that there are no shortcuts in life. Lottery winners, professional athletes, and successful business owners can and have gone bankrupt just like anybody else. The key to building wealth and achieving financial goals is to develop, implement, and adhere to a comprehensive financial plan throughout a lifetime. So when we talk about developing a financial plan and setting goals, what potential life events does that entail? So this slide will show some of life's key events, some happy, such as a marriage or the birth of a child, and some not so happy, such as divorce or the death of a spouse, all of which can have a significant impact on your life and your finances. Now, I don't expect everyone to have a prepared plan for all these potential events, but rather an awareness that when an event occurs, or if you anticipate an event such as this occurring, that it's time to re-review your finances and hopefully make educated decisions. So let's jump into a few planning topics and discuss some best practices. The first is budgeting, and budgeting is probably one of the most critical components to creating a financial plan, but it's also one of the things that most people hate to do and really struggle to follow. However, without a good understanding of your personal cash flow, it's nearly impossible to frame out a strategy for eliminating debt and building wealth. What I've provided here today is a brief guideline for building a budget, and it's called the 50-20-30 guideline. 50% of your take-home pay should be dedicated to fixed costs such as mortgages or rent, car payments, student loan payments, phone bills, etc. 20% of your take-home pay should go to savings such as retirement or paying down the principal of loans or establishing an emergency cash savings plan, which we'll talk about next. And the last 30% should go to flexible spending, the fun stuff, entertainment, clothing, food, gas, etc. So that's just a real quick breakdown of how you would look to construct a budget. There's some great websites out there. Mint.com is a free website that has budgeting tools. I have a great spreadsheet I use in Excel, so if anyone has an interest in using an Excel-based budgeting sheet, feel free to reach out to me after the presentation. I'd be happy to share it with you guys. The next slide we're going to be talking about is that emergency savings fund. And if you don't know what an emergency savings fund is, it's pretty much exactly what it sounds like. It is a savings account or some type of short-term investment that is really put aside for emergencies. And the rule of thumb when it comes to planning is you really want to have 6 to 12 months of living expenses set aside. So what you have to do is establish that budget first, figure out what you really need to live, even if it's on a bare bones budget, and then the initial goal is then to start accumulating assets, in case something goes wrong. And the 6 to 12 months really comes from what we see as the average duration of unemployment. So if you're unfortunate enough to lose your job, it typically takes, the average American 31.7 weeks to find a new job. So you want to have enough cushion there to obviously get you through those hardships without, incurring any significant issues. And I put up some statistics up here, which are from bankrate.com, and they show the nation as a whole and really how many people are following this rule. And you'll see about 1 in 4 Americans have no emergency savings whatsoever. Another 24% have less than 3 months, but have some. And then we have maybe about 40% here that have 3 months or more. So really there is a huge shortfall in where people need to be in terms of building those cash reserves. So it is a critical component, and really before I would tell anyone to start, investing their money in stocks and bonds or anything like that, this is really, really a priority. The next thing we're going to talk about is credit. And, credit, if you're just starting out of college, it can be a lot harder to get going than it was when I was in school 15 years ago. Back then, you used to get credit card offers in the mail almost every day. Now it's a lot harder of a process where you need to get a cosigner, such as a parent or a guardian, or you need to basically put up collateral and get a secured line of credit. So it is important to get credit established as you go through life, whether you want to get a car or buy a house or get loans for continuing education. But once you do establish credit, you want to make sure you pay your bills on time and try not to use more than 30% of your available limit. When you go over 30% of your available limits, it shows the credit card companies that you're using too much leverage or maybe not using the credit card judiciously, and it'll reflect on your credit score. So you really want to stay under 30% of your available limit, meaning if you have a $10,000 credit limit, you never really want to have a balance of more than $3,000 on the credit card. And that'll lead to you having a higher credit score, which as you go, again, through life and get cars and houses, you'll get the best rates, which is a critical thing when you look at the amount of interest you pay over the life of a loan. You also want to strive to pay off your credit card balance every month. I know that's not always possible, but it is something that you really should emphasize doing. If you're like me and you get those promo codes once in a while where it's 0 APR for a year, if you want to do that and leave a balance on there and pay it down over the course of a year or 18 months or whatever the promotion is, that's certainly fine. I just don't advise anyone to carry a balance if you're paying a 12 or an 18% interest rate. It'll really, really hurt you in the long run. Lastly, when it comes to the credit score, just one credit card really doesn't do much to build out your credit report and in fact report a credit score. So the target is to have three essentially lines of credit, and you want to have both fixed loans such as a fixed car loan or a fixed mortgage, and revolving lines of credit such as a credit card or a home equity line of credit. So if you're just starting out, obviously get the credit card. Then, if you're looking to buy a car, you may want to get an installment loan from there. Right now, interest rates are low enough where if you're paying 2 or 3% on a car loan, it's really not that big of a deal. But as you continue to hopefully establish lines, pay them on time, keep your balances low, you will, develop a 700 plus credit score. Really what most banks and credit unions look for when it comes to lending is they look for scores of 740 or above. That's where you'll get the best rates and the best pricing. And I've noted down here 2 websites that are really helpful. The first is if you want to get your annual credit report free. You can get it from any of the 3 major credit agencies, and it's not freecreditreport.com. Freecreditreport.com is not, in fact, free at all. You actually want to go to annualcreditreport.com. The other website, which you've maybe seen some marketing out there for, is creditkarma.com. And if you sign up for Credit Karma, you can either get your credit score from TransUnion or Equifax. You get it, I think it updates every 2 weeks, so you can go in there, and it's nice because you can see if anything is hitting your credit report. So you can see if, a new credit card was open or a new line of credit was open. So that's good if you're doing it, but also from a fraud prevention standpoint, where you want to go in there and make sure that no one else has gotten access to your Social Security number and established anything online that you're not aware of. There you can actually link up your credit cards and your personal bank accounts and kind of look at an integrated picture of your finances. And again, it's all free, so I'd highly advise taking advantage of it. So let's move on and talk about really one of my favorite topics, which is retirement planning. And retirement planning boils down to three questions, which is, when do you want to retire? Where do you want to retire? And what do you want to do in retirement? And for those of us that are in their 20s, 30s, and 40s, that's not an easy question to answer at all. But as we head into our 50s, 60s, and 70s, those answers become easier and easier to articulate. So if you're like myself and you're in that younger category, how can you start to, put together a plan to ensure that you're going to have the highest probability of achieving success in retirement? And there's two general guidelines I've listed here that really, if you follow these judiciously, it will put you in a good position going forward. And the first is what I call a household income multiplier, and it's by age. And it's really a goal for you savings-wise. So if your income is $50,000, by age 35, you'd want to have about $50,000 put aside in your retirement. At 45, you'd want 3 times your salary. So if that was still $50,000, you'd be targeting to have $150,000 there, and so on and so forth. And by doing that, you essentially should have a reasonable nest egg set aside by the time you reach full retirement age. Right now it's 67. That with the combination of what you can draw off of your retirement accounts plus Social Security, you would have a reasonable standard of living. And how do we get to those targets? It's really by setting aside 10, more really realistically 15% of your income aside. So the next slide we have here is an example of really the power of starting to save early and saving at that savings rate. So I took 50,000, which is what I would consider to be a reasonable household area for us geographically in the greater Philadelphia area. And I used a 40-year time frame. So if you presume, you're in your 20s, you're just out of school, and we're going to work hopefully into our 60s, and we took that 15% annual savings rate, which can be broken up in a couple of different ways. So presume you got a job and there's a 401k plan offered through your employer, and they offer a 6% match on a 6% contribution. So you put in 6, they match you 6, that gets you to 12. And then on top of that, we put aside 3% a year of our income into an individual retirement account. Now, again, not every employer does 6 and 6. It may be 3 and 3. However, it works out, you want to get as close to that 15% as you possibly can. I also adjusted up our income 3% a year and assumed a 8% annual investment return, which is, a projection based on the historical returns of the stock market over, say, a 40 or 50-year time period. Again, 8% is not necessarily guaranteed, but it's certainly a realistic expectation for somebody that's going to have a 40-year time frame. And believe it or not, if you do that and you do it continuously for 40 years, you will have close to $2.8 million, which is a rather significant amount of savings for somebody that has what I consider a modest income. So it is very, very possible, if you implement a strategic savings plan and adhere to these goals, that you don't need to make a ton of money to have a nice amount of money set aside for retirement. You just have to be judicious and do what's right. So let's look at how those numbers compare to what's currently set aside in retirement accounts. So the next slide here was put out by the Federal Reserve, shows the median value of retirement accounts for families with holdings. And it's grouped by age, and it shows, and this is from 2013, the balances, the average balances for those different age groups. So if you look at 65 to 74, it's about $149,000, which is a heck of a lot less than the $2.8 million figure that we just looked at. Now you have to keep in mind that $2.8 million, 40 years from now is not worth the same as it is today, but nonetheless, that is a staggering difference in account balances. So it can show you, obviously, that if you do things, again, right, you can be way ahead of where most people are. And then the next slide, which was put out by the Social Security Administration, shows a breakdown of where retirees are getting their income from. So right now, 30%, 37% of income is being derived from Social Security. Only 19% of it is coming from 401ks or pensions or annuities, 11% from what we call taxable or non-qualified investments. And then the part that kind of scares me a little bit is 30% is coming from earnings. So retirees that have to continue to work in retirement. And I don't know about everyone on the call here today, but I really don't want to work in retirement. So it kind of motivates me to continue to save and want to work to avoiding that in the future. Because quite frankly, I'd like to get out of the workforce as soon as possible. As we move on, I want to talk a little bit about insurance. Now, insurance is obviously not the funnest topic, especially when you're talking about disability and life insurance. Disability is probably, in my mind, one of the biggest risks we have, because at no age is the risk of death greater than the risk of becoming disabled. So if you're like myself in your 30s, your risk of becoming disabled, which means you aren't able to basically go to work and do the job that you do every day, is about 4 times that of the risk of you dying. And it becomes less and less, obviously, as you get older and older. But even as you get into your 70s, you know, it's still a slightly greater risk of you becoming disabled and dying. So we target, from a planning standpoint, to have disability insurance that would replace 60% of your base salary. So if you're making $50,000 a year, we would want to make sure that you have at least disability insurance for $30,000. And that 60% really, it's a loose number, and it comes down to budgeting again, but the thought basis is if you're not going to work every day, maybe you don't need to go out and buy nice clothes. Maybe you don't need 2 cars anymore if you're a family. Maybe you only need 1. Gas, goes down. So a lot of expenses diminish when you're not out and about in the workforce every day. Now, most employers will offer disability insurance, and usually at that 60% replacement requirement or replacement advice. But if you are an independent contractor, like a real estate agent, or if you're a small business owner, this is really a significantly important planning aspect to ensure that you have adequate disability insurance, especially if you work with your hands. I have a client that's a stenographer, so she types all day in the courtroom. God forbid something happens to her hands, she, essentially loses a very lucrative career for her. So this was a major planning concern for her when we went through everything. The next thing is life insurance. And I really only recommend to my clients to buy term life insurance because it has the lowest cost and it's the purest form of insurance. So term insurance works like this. Essentially, you pick a number of years, whether it's 10, 20, or 30, and you pick a face amount, say $250,000, for example. And you pay a fixed premium every month, and it's rather inexpensive for somebody in their say 20s, 30s, and even 40s. Maybe it's $20 or $30 a month. And God forbid something happens to you over that time frame, your beneficiaries get that lump sum of money. And it's really important to have life insurance if you're a single income family, one parent or one spouse is the sole breadwinner, or you have young children that are, obviously still in school, or, have college expenses that could potentially come up in the future. And I usually tell families, target what your debt is. So if you owe $250,000 on your house, a good starting point for insurance is probably around $250,000. It won't break the bank to, have that extra $20 a month expense, and it'll protect you, God forbid something happens. Unfortunately, with life insurance, you never see the benefits of it. You always see the cost of it, but it really boils down to peace of mind. So those are the two, what we look at it from a planning standpoint that are really the most important. And I wanted to give you guys just a quick synopsis of how to approach it and what the lowest cost ways of getting it are. The next piece, and really the last planning piece I'm just going to quickly touch today, is estate planning. And again, it's somewhat of a morbid topic, but it's something really, really important. It's something I have clients that, put it off for most of their life. And by the time they're in their 70s, they still don't have it when the risk of death, unfortunately, is a lot higher than new parents would be. But when we talk about estate documents, we're talking about last will, power of attorney, and an advanced healthcare directive. And some of the key components to those documents are naming a guardian for your children. So God forbid mom and dad get into a car accident, where do the kids go? Every family has different thoughts and opinions upon what they would want to see, but it's important to have those thoughts down in writing so that they're followed should something happen. Also, from the standpoint of the kids, I highly encourage my clients to establish what's called a testamentary trust, which is a trust under will. And basically, it just sets up a way that your assets would be distributed to your children. So if you don't have a will in place and you unfortunately pass away, when your child turns 18, they get whatever was left there. I know how I was at 18, and I know how most of my friends were at 18. And quite frankly, I don't think it's in the best interest of the child to give them all the assets carte blanche at age 18. So what you can do in a testamentary trust is outline how you'd like those assets distributed. So myself, from a personal standpoint, I put it that 1/3 of the assets would be given to my child at age 25, and the other 2/3 would be given to them at age 30. Spread it out, wait a little bit in life where they would get a little more responsible and grasp their own finances a little bit better. You also name a guardian for those assets. So those monies that are set aside can be used for college or any of their living expenses throughout the course of their life, as long as the guardian trustee approves it. And then if there's still things remaining after that time frame, they would get the payouts as we noted. So it's just something that's really simplistic to do, that's built into the will itself. There's not really any extra significant cost to setting up a testamentary trust versus just drafting a normal will, but it's something that's really, really important, and I would highly encourage everyone to have a discussion with their attorney. The Advanced Healthcare Directive really establishes medical preferences. So it comes down to those decisions where really it comes down to if two doctors say that there's no realistic chance of you coming out of a coma, say, for example, that you kind of set up the guidelines what should happen to you, whether you want your organs donated, things along those lines. Again, not the most uplifting topic, but something you want to give some thought to maybe take the burden off of family who may be significantly emotionally involved should something, drastic happen to you. So another topic that's really, really important. And I outlined the cost of the attorneys I work with for estate documents. Some are as low as $400, some are up around $1,500, but we're not talking about thousands and thousands of dollars in expenses here. I would advise you guys to use a physical attorney that you can sit down and have a relationship with and have physical dialogue with. I've seen, and I don't mean to disparage LegalZoom, but I've seen some nightmares with pre-drafted or template documents. You really want to sit down and have a conversation with somebody and let them get a feel for exactly what you want to happen. Again, $400, not an insignificant amount of money, but it's money well spent. With that said, that's just a couple of the topics I wanted to outline for you guys today. If you have questions, feel free to type them in now. I'm happy to answer any questions in detail. With the time frame we had here today, I thought it was best served to give you guys just a quick overview of a few best practices. Obviously, when topics like retirement planning and credit, we could do a whole heck of a lot of these the webinars in the future. But if there's anything on your mind, I'm happy to answer it now. Okay, guys, doesn't look like we have anything coming through at the moment. So at this time, I'd just like to express my sincere appreciation for everyone in attendance today and to the alumni office for putting together this fantastic platform for us to really share our expertise with all of you. Should you ever have any questions or concerns, my contact information is listed below. You can always feel free to reach out to me anytime. Thanks again, everyone, and have a great day.